Now, as yields climb, we're seeing a market reaction. The Nasdaq comp, within the last couple of seconds, has now fallen 10% from its November high into correction territory. So what we're seeing here, yields rising, stocks falling. The question is, how much further do both of those moves have to go? Janet Mui, head of market analysis at Brewin Dolphin, joining us now. Janet, you've got a positive German 10-year. You've got the Nasdaq comp falling 10% from its November high. What do you think of these moves? Do they have further to go?
Good afternoon, guys. Thanks for having me. I think all these moves suggest that we are in a year of further normalization, which is, in a way, not a bad thing. German yields trading in negative territory was absolutely extraordinary, and that was being driven by the pandemic and the central bank policy and the ECB dovish stance, obviously. And I think what we are seeing this year is going to be further normalization. We are moving towards the endemic, as a number of health experts have been contemplating the idea. And what we see is that the major central banks, of course, including the Federal Reserve and the Bank of England, likely to raise rates 3 to 4 times this year. It is because the economy is recovering, and these emergency measures are just no longer needed. And not only we talk about interest rate rises, but also the balance sheet wind down. So I think that lifted just global yields across the globe, and I think that would have further to go. I think the U.S. yields are within touch of 2% for the 10-year, and I think it's not a matter of if but when.